people are starting to get worried about something they haven't worried about in a while, and that is their job.
Yeah. Well, I think there's all kinds of articles about this. Obviously, everybody knows about Doge, right?
Mm-hmm.
And I think I read there's about 75,000 people that actually retired, I guess, or took the buyout. And then there's like another 170-some thousand coming. But other than that, I think we're starting to see inflation hit the employer, and the employers are starting to take a look at their bottom lines. And so things are changing a little bit right now.
It is. Labor force participation rate decreased to 62.4%, and that's the lowest level since January of 2023. And remember, in January 2023, everyone was still getting their stim money, right? So if they weren't working, they were getting stimulus money. So that's something to take into consideration.
Yeah, so what that means on the other side of that is that there's 37% roughly that are not participating in the labor force.
Right. Now, that could be by choice.
It could be, yeah. I think it's important that when we look at these unemployment numbers, right now we're at 4.1. And while that's up from 3.7, I think it's important to understand the difference between what, we've talked about this before, U3 versus U6. So, Jerry, could you put that chart up real quick? Because I think U6 is a better chart. Now, let's take a look. On the left side, you can see the U3 rate. That's the one that you're going to see in the media. On the U6, this is the one that I think you should also just keep your eye on. And oddly enough, we could only find the chart through January. It's actually 8.5 right now in March. So it's gone up from 7.5 to 8.5. And U6 is the wider group of people. It's always higher than the U3, as you can see. And essentially, these are the discouraged people, the underemployed, the part-time. So it's a bigger category. And I think it's just something to watch because the media never reports on the U6. But really, you're looking at an 8.5%. And if you go back and you take this all the way back, you can kind of see that we haven't really been there in quite some time. I would say what looks like about 2008. Probably somewhere in there, where it's been 8.5, let's say. Mm-hmm. So that's a bigger concern, in my opinion, because the first thing that happens with employers, as you guys know, is they'll cut back. They'll go from 40 to 30 to 20 or part-time as they start to see their rising costs and how can they do things better through ChatGPT, through AI, through consolidation, whatever it might be. So that's probably good with that, Jerry. Thanks. That's something to watch. Even, however, they do say that unemployment under 5 is considered healthy.
Yeah, no, we're definitely not in a time of high unemployment. So anyone that tells you that the, job market is, crashing and we're in a recession, no, we're definitely not. 4% is still considered very healthy. But the issue is that we have went from 3.7 a year ago to 4.1. If the trajectory keeps going and accelerating, and once we start to get about 6% is when economists start to get kind of concerned.
Well, I think over 5. So you got to, by the way, 4.1 represents 7.1 million people. So when you actually talk about the number of people, it's a little more meaningful, right? So if it goes to 5, you're talking about quite a few people. You're talking, and if it goes to 6, you're obviously in the 8 to 9 million people. So that's the bigger issue. When you actually look at the number of people that are dealing with this, that are unemployed, it does translate down into the rental market, does translate down into buying choices and consumerism, and all, of course, the purchasing of the single family side.
Yeah, and Powell's definitely watching the unemployment rate. So the Fed has 2 jobs. They have to watch inflation and watch unemployment. They've been really focusing on inflation right now because that's been the issue. Unemployment has been low since 2020 or 2021. So now, they're starting to focus now, keeping an eye on that job rate because, it would be interesting to know if inflation is kind of high and the job loss grows, which one the Fed would choose to really pay attention to.
Right. And if you guys you were with us when we started talking about Doge and what it did to let's say just up in the Northeast, where it's heavily concentrated in the public sector, federal workers specifically. And we know for a fact that home prices went down $100,000 in the submarket that we were looking at, mostly up in the D.C. Maryland area. So we know that for sure, and that was a direct result of people losing their jobs in a specific area. Now, it's not systemic, it's not national, but that's what it can do when people lose jobs. That's what happened up there is exactly what it can do. What's really interesting is if you take a look at the unemployment rate for the states, the lowest unemployment rate in the country is South Dakota at 1.9. The highest is Nevada at 5.8. Mm-hmm. Now, why would Nevada be at 5.8? There's a bunch of reasons. From somebody who used to live in Las Vegas specifically, it's one of those places where you fly in, fly out, spend a couple days, you spend $1,000+ on your room and your flight and food and all the other stuff. And those of you who gamble, it could be significantly more. When you start to see areas like that creep up, that's a direct. Vegas is a really interesting barometer for the consumer because people pull back and then things pull back. And so they're at 5.8 there in Nevada, even though 4.1 is the national average. So there are things to watch for you real estate investors from state to state as well.
Mm-hmm. Absolutely. But all of this uncertainty is affecting the stock market, which I'm sure a lot of you have heard, and also it is affecting the real estate market. Buyers are a little bit more hesitant now because if they don't feel secure about if they're going to have a job in a year from now, they are more they're withholding on big purchases.
They are. And I mean, there's article after article. CNN has one that says the job market is frozen. I actually think the real issue is, I was talking to my partner the other day. I said, do you think wages and costs and everything that we deal with in our company are going to be up or down in the next year or two? And he's like, every single person I talk to says up for sure. So if your income isn't up that much, just like you would do personally, you're going to start to take a look at all of those costs and the efficiencies and things like that. I think I mentioned before, my really good friend has a very large advertising and public relations company. And he told me, I was with him last weekend, he said that he went from 160 people to 110. Now, all kinds of reasons. One was his income was up, but not a lot. But the real reason was that costs were up. And so he started looking at ChatGPT, AI, writers and stuff like that, all these things that he could utilize online to try to make his company more efficient. And those are all people that he used to have on staff. And so as we start to see some of this technology and things like that, I think you're going to start to see more and more and more of this. And obviously this has been a bullet that's been coming for quite some time.
Absolutely. And I think you do have to consider, some of these home building costs as well. So let's dive into the Florida and Texas market, because Florida and Texas are seeing the most price declines in homes right now. And, there's more inventory stacking up in those two states than anywhere else. A lot of this comes down to insurance, right? Insurance, especially in Florida, has really went up.
Well, Texas too.
Texas, it has as well. It's just not as well known unless you live in Texas.
I've been hit with a hurricane in Texas. Mm-hmm. There's a lot of weather in Texas, guys. Yep. Like I've had freezing pipes in Dallas and Austin and Fort Worth. We've had hurricanes in Houston. Those Gulf states get pounded.
Yep, absolutely. But I think it's interesting to note that even with that, with the major price declines, they're only showing about a 2% price decline in Florida right now on actual sales compared to last year.
Because
that's why we always talk about, you can't just look at what people list the property for, because people say, oh my God, it just dropped like 20%. Like I'm out looking at homes right now, and there was one that was listed at 715,000, and now it's at 650. It's still overpriced, but somebody could look at that and be like, oh my God, this home has went down, $65,000, but it's just overpriced. It should be $6,000. They try to list it at 715. They're going to have to learn the hard way. So, but the point is if you actually look at the data in Florida, which is one of the hardest hit states, the actual sales price from last year of homes that are actually closing is only down a couple percent.
Now, that's by the state, though. There are pockets
Correct.
that are getting annihilated. We know that. Airbnb's a little bit in trouble in specific areas. The one thing, though, really keep your eye on is some of the public companies, like I think Lennar hit the newswire last week. Lennar Homes is obviously a big privately or a publicly traded company. And their costs for selling a home are at 13%. And just to put that in perspective, 2 years ago, they were at 1.5%. So think about that. That's $52,000 on a 400,000 square foot home. So let me say that again. Their costs to sell a home are at 13%. And the reason why this is good data is because they're public and they show it. So a $400,000 home costs them over $50,000 to market and sell. Now that could be rate buy downs. It could be all kinds of stuff. But just 2 to 3 years ago, it was 1.5%. So their cost went from $6,000 to over $50,000. That is a direct hit to that home builder. And so that's really interesting to watch right now, because as you start to set, means that they're really stretching. They're trying to get buyers into these homes. Maybe they're priced out. Maybe their sales and marketing isn't working quite what it was. The buyers aren't lined up like they used to be. And unsold brand new single family home sales are at an all-time high, the highest since 2009.
So that's what I was going to say. So Lennar is an interesting example. So they just did their investor call. Their earnings are down. Their typical, what do they call that? Concession is 6 to 7%. To your point, right now they're doing 13. They're doubling it. However, they're selling more homes than expected. That was the interesting part of the report.
That's the spin of a sales call.
Well, no, but they are. Their demand is higher. They're selling more homes than they said they were going to sell. They're selling them for basically less profit because of the 13% concession that they're having to do, but they are selling more. So
that's like the old adage where the guy goes, hey, man, like our margins are down. And he says, oh, no, we'll make it up on volume. If their cost of sales doubles, they're getting hit in the short.
But no, they are. But I think it's important to note, though, that there are buyers out there. If we were going through another 2008, they wouldn't be selling any homes.
Yeah.
They're able to sell these homes. They just have to offer more concessions, which is essentially lowering the price.
It's the rate buy down.
Yeah, they're buying down rates, right? So they're saying to people, you can't afford your interest rate. Let's buy that down for X amount of years, and you have a lower rate.
But this is definitely a sign of there's no way that they're raising prices.
No.
When their sales costs more than double, they're not raising prices. Okay, so that I think is the point.
Well, and correct, and if some of these tariffs really do come to fruition, that Trump keeps promising and not promising and promising
pre-tariff and post-tariff.
So if their building costs go up and they can't sell these homes for anymore, then that is going to be a problem for them, and they may not continue to build like they've been building because they're already losing money now. So if the cost is going to go up, you can't just charge the consumer if the consumer is not willing to pay that price.
You can't. No, that's my point. I think the question is have we hit the ceiling? That $400,000 mark was kind of a, when we crossed that, which is not long ago.
Like 415 or what was it?
Yeah,
something like that.
I think it was, and that was kind of a psychological barrier, I think, for a lot of people.
I do. Well, and I think people really take everything down to their monthly payment, and then they can't afford anymore. I look at, I'm out looking at homes now, and they always give you your monthly payment if you put, 10% down or whatever. And it's insane. You know what I mean? It's a lot of money for a lot of people. But my question is because, I'm a realtor, so I've been hearing other agents talk, and, the builders are on these new homes, they're buying down the rate for 1, 2, or 3 years. My question is, if rates don't, because the whole spin is that we'll buy down this rate. By the time this expires, rates will be down, right?
I wouldn't do that deal. I would say it has to be the whole term.
Exactly, right? So they're doing the rate buy down. So now the problem though is are we going to see another issue in 2 or 3 years from now when all of these rate buy downs and the rates haven't really gone down, if they haven't, come up and people can't afford their payments? I mean, that is something that could trigger, kind of a big issue for the housing market.
Yeah, the Fed has been clear. I mean, if you look at they've said there's been all kinds of speculation on 1 or 2 rate cuts, and they're going to be like a quarter each. So I would not expect 2025 to have any real rate cuts. One thing to also watch, which I watch, is called dot plot, DOT-PLOT, dot plot. Dot plot is a really interesting thing. Those are all the chairs of the Fed and kind of where their head is, right? And so there's a dot plot, which is kind of forward thinking. And so I don't think, if the only thing that you're not going to see any significant rate reductions this year, in my opinion, on the interest rates, although the 10-year was at 4.2 today, I think. However, you might see in some areas excess supply driving prices down, right? So that's, we could see in the early stages of this. And then when you overlay the potential unemployment issues, which we're now at 7.1, what we could see is some
we're
softening.
At 4.1.
Yeah, or 7.1 million people
okay,
is what I meant. Yeah, 4.1%, but really 7.1 million people. And the U6 rate, of course, is up at 8.5. So there's discouraged workers and part-time workers, which is part of that. They're not buying homes anytime soon. So so all of this is going the wrong way.
Yeah, and it's interesting though, because everyone's always waiting for this big housing market crash, and we always say on here we don't really think there's going to be a big housing market crash. You do have to pay attention to the unemployment, because higher unemployment is going to mean less buyers, and less buyers is bad for sellers, good for people that can buy, right? But we're already seeing that in the markets. Like, a lot of markets right now are a buyer's market. Like Phoenix, I am looking for homes right now. It's a buyer's market. Does that mean that prices are slashing left, right, and center and dropping, 20%? No. In fact, I placed a full price offer on a house yesterday and didn't get it. So no, they are not falling as you may think, but things are sitting on the market 30, 40, 50, 60 days, and people are having to price cut. And things that are sitting longer than 60 typically are overpriced. So people are having to price cut. So it's a really good time to be a buyer, because you can negotiate with these sellers where you couldn't have done that the last few years. But the market's not crashing. There's a lot of buyers still out there. And right now we're seeing increases in inventory and also more transactions. Like, there was way more transactions in February than there was in January. And now we're going to be looking into March, where I think there'll be more transactions as well, because there's more inventory.
Yeah, I just think this is slipping back to normal.
I know, nobody's used to normal, right?
Yeah.
They're like, oh my God, like
right.
I have some buyers looking, and they pulled up a house they wanted to see, and they're like, but we're worried because it's been on the market 23 days and it hasn't sold. So is there, there's probably something wrong with it. And I'm
hold
like,
on.
23 days.
I had this exact conversation with you.
Well,
I was like,
yeah.
wait. You're sitting there like pointing fingers as if it didn't happen to you. Danielle listed something, and she's like, I haven't had any offers in 5 days. And I looked at her and I go, it's been 5 days.
But I hadn't any showings.
You're so spoiled.
It was the showings that was bothering me.
Like, listen, like this is the behavior is interesting, right?
It is.
Like, if you guys, like, there's time typically, real tension between a buyer and seller. There's supposed to be time. Yeah. Right? It's not supposed to sell or get offers in the first few days.
Well, I look at that too with my rentals, right? Like, I'm used to my rentals running in like a week, and you were like, it's okay if it sits 4 weeks, like, wait till it sits a month, and then if you still haven't had showings or people wanting to rent, then you can kind of reassess.
So we had this conversation yesterday. I said to Danielle, she's already trying to figure out a 1031 solution for something that is not even closed.
Well, I get anxiety.
I know,
you
but I
only
just
have
to
45
laugh.
days
By the
from
way,
when it
I
closes.
get it. Listen, you don't want to pay tax. But I said, why don't you get to the point where the seller's completely signed off and the loan's completely done and you're almost at closing. There's nothing wrong with looking, but don't fall in love with stuff yet, because you do have all those time frames on the 1031s of 45 days, the 90 days, the 180 days. You have all those things. So you don't have to close for 6 months. I know you have to identify, but so anyway, we have these exact same debates in the household. I'm used to cycles. I'm used to, stuff being on the market for months, half a year. I'm used to that. That's my history. Danielle's not. She's been a spoiled little millennial.
I have.
Well, are you a millennial technically?
Yeah, I'm a millennial.
Okay.
The oldest millennial you can be, but I am a millennial.
Okay.
So.
Well, I just have to laugh because she's like, I want it now, and now's not soon enough.
Well, and let's talk about why buyers are pulling back, right? Because there are reasons buyers do pull back, and one of those is these high interest rates.
Yeah.
So if the interest rates are high, if the job market starts to falter, then that's typically when Powell's going to start lowering the rates.
Maybe, yeah.
Possibly.
We will see. I mean, Trump definitely wants that.
Mm-hmm.
He, in his last presidency, he was pounding on all the time, right? He wants low rates. He's a real estate guy. For sure, he understands how that works. However, low rates also produce bubbles.
Right.
And, they get the whole economy going. And so, 4.1% unemployment is not something to be freaking out about. And don't forget, inflation's in line.
It is. This is, it's so funny because on paper, we're living in a pretty good economy. We have low inline inflation.
You watch the news, you wouldn't think so, though.
And we have, a job rate that is healthy, 4.1% unemployment. Now, it can always tick up, right? Unemployment can tick up, inflation can tick up, and that can affect things like stocks and real estate. But in this moment, it's like this impending, doom. And Alex commented on YouTube, he was talking about buying a house 2 years ago, and a bunch of people kind of told him, don't buy it. Everything's gonna crash, and he's like still waiting for that, right? And sometimes
I think that's normal.
It is normal, but when people do that, sometimes you miss out on opportunities because you're just waiting for another 2008. But the truth is, if 2008 happened, you still wouldn't buy because one, maybe you lose your job and you can't, or two, you'll be like, but it could go lower, but it could go lower, but it could go lower, and you just wait. You know what I mean? And then
I went through 2008.
I know.
You guys know I was building a home in 2008, like. Me, less smart. I was like, really? It's actually the greatest story ever. 2008. Before that, I bought some land, designed my own home, built the home, G-seated, all that stuff. And when I was done and the dust was settled and I moved in, it was worth less than I paid.
Yeah.
To build it. However, as my home, it was a lot. I still own it, actually. That was 15 plus years ago. And so it can happen. But your personal home is different from an investment, right? So what we always preach, and like Danielle's out looking right now, she's looking for $500,000 homes in Scottsdale that rent for $3,000. And that math works all day long. Mm-hmm. So as long as you're from a real estate investor, if you're looking, and by the way, those are right down the middle numbers. She could probably get a little bit more in some areas. As long as the math works with the mortgage, the insurance, the HOA, if there is one, and all the things, you're going to cash flow at that number all day long. So there's plenty of deals out there. So I'm always looking.
Yeah, and the math works on some of those deals, but you need to put down more than 20% because of those high rates.
Of course.
That's the problem too. Is the slowing down in the housing market. From what I've seen, it's a lot of investors are slowing down. I don't see as many first-time home buying is actually up the last couple months than it has been all through the pandemic years because people can actually negotiate, maybe get a price they want. And they're not competing against investors because right now unless you're putting down a significant amount of money, it's very hard to find a cash flowing property when rates are, I mean, for an investment property, I bet rates are at 8%. I mean, they're 6.8 for a home you're going to live in, but they're probably 8 for one you're going to, invest in.
I like the quote that you picked up this week with Peter Thiel. I thought that was really, really interesting. For those of you guys who don't know who Peter Thiel is, he manages a huge fund. He's one of the founders of PayPal. And he's talking about the global real estate market. And what he said was just a 10% increase in a city's population can create over 50% inflation in the price of a home. Now, so I started doing the math when I read that because I thought it was an interesting quote, right? And he was trying to compare it to wage growth. And so I looked at Scottsdale. Scottsdale's like 250,000 people. 10% is, they call it 25,000 people. And guess how many homes are listed right now in Scottsdale? Less than 3,000. So to his point, if Scottsdale grew by 25,000 people and there were only 3,000 homes, of course it would, the home price market would go like this. And he said, if you own a home, if you're in the game, if you've got a hard asset, you're actually going to be the recipient of that. So one of the really interesting things that you guys should be paying attention to is where are the people going? Where, from a migration standpoint, we talk a lot about this, but he could not be more right in this issue. You're going to put, when people move to an area, it puts pressure on the whole system. It puts pressure on the schools. It puts pressure on the restaurants. It puts pressure on the hospitals. It puts pressure on rent. It puts pressure on the housing market. Everything has pressure as a result of that many people moving. Now, that's a little bit of an exaggeration to have a 10% growth in the population, but the point is the same, and it's a good one, is, if you want to see where the opportunities are going to be in the next several years, take a look at where the U-Haul trucks are going. Take a look at the out-of-state driver's licenses in these cities and states. Take a look at the unaffordability and the safety issues and the property taxes, the insurance, and all the things like we were just talking about with Florida and Texas, for example. And where are those people going? Take a look at California. Where are those people going? And what it does is it puts pressure on those other submarkets, and that's kind of the point.
I think it's interesting, too, where you were talking about where are people going, because I think in the pandemic years, I think people went to better weather because they were working remotely and they were like, what the hell? Why am I going to go sit in my office in Ohio in the freezing winter when I can move to Florida, when I can move to Arizona, when I can move to Texas? But moving forward, especially if we go into a recession and job losses increase, people are going to go where they can get a job, like, period. It's not going to matter the weather. It's not going to matter the location. If you're unemployed, making no money, and you need a job, you are going to move for it, period.
Or family, yeah.
Family.
They'll double up, or you're right. They'll double up. They'll go to where safety's in numbers. That's for sure. And then to your point, they're also going to go where the jobs are.
So where the jobs are going to become very crucially important in the next few years, because I do think we're headed for higher unemployment. Now, does that mean a recession? I don't know. But we're definitely going for higher unemployment. So people are going to move where jobs are. So when you're investing, you should look at where the jobs are in that, how the jobs are looking in that area. Are they pro-business? Are they pro-new business? Are they offering concessions and tax breaks to move businesses in? Or are they upping regulations, making it more difficult, to hire? Are they raising minimum wage so that maybe companies don't want to be there? You have to look at that stuff, because that stuff is what's going to matter if the unemployment starts to tick higher.
And you should, obviously, we all know that Trump's agenda, he's been super clear on make America great again, whether you believe it or not, or would agree with it or not, is kind of irrelevant. He's definitely trying to bring manufacturing back, using tariffs of leverage, all of those kinds of things. Nuclear power, another huge thing to be able to run AI. We already know this is happening. There are definitely things that are going to happen with this administration, and all you got to do is be in tune with it. That's it. You're going to start to see, we're already seeing, I've been talking to some of my friends that are moving things that they used to do out of the country back into the country because it doesn't make any sense. It's exactly what he wanted. I actually talked to a friend friend of mine last week that was in town, and he actually outsources some of his stuff to China, and he's bringing it back into the U.S. specifically because there's no after you put the tariff on there and after you ship it and all the things, it doesn't make a lot of sense anymore, and he can do it locally. It used to be U.S. made, and he outsourced at one point specifically to try to capitalize on the cost savings because the costs were higher, and now he's pulling it back. So I think you could start to see that. And for those of you who are in the know, I'd love to see your comments on this because I'm already seeing certain people going, you know what, now the costs, that doesn't really make sense. And before, if you think about it, the fragmented system, if you could have stuff made somewhere else, bring it into the U.S. and make your margin, great. But now it doesn't make as much sense anymore.
And just to clarify, because there's a lot of questions on, YouTube right now. So on the $500,000 home that is, renting for $3,000, you definitely need to put more than 20% down.
That's her 1031.
It's a 1031. So things are not cash flowing right now with your standard 10 or 20% down. They're just not. The rates are too high. The prices are too high. So something's got to give there. That's why you don't see a lot of investors in the market right now.
But let's take that the next step before. So Danielle was looking at her what we call the imputed equity, and this is important. She's looking at the amount of equity that she's got sitting, which is right now in a condo. Mm-hmm. What does the condo make net? Period. And the rents are significantly less for a 2-bedroom condo. So she's looking at that, and she's like, if I move it laterally and put a little bit more money in, she actually makes almost twice the rent.
Right.
So that's how she was looking at it personally, and the majority of her equity is coming from the condo.
Correct.
Right? And she's got to top it up with some extra money because the condo doesn't exactly equal 500, but you get the point. So when you're looking at your return, you have to look at the imputed equity. What do I have in equity, and what am I making off of that equity? Period. And then can I move that laterally to something else and make more money off that imputed equity, whatever it is at the point?
Exactly. You have to really look at your return. Ken actually had me do that because I really wasn't looking at that. But I actually have another condo that has a 2.6%, I think, rate on it. And I'm actually making more, even though I'm making less money on that one because that one actually has a mortgage. And this one that I'm selling doesn't have a mortgage. I'm making more based on what I actually have invested, because I only have invested in that one like $100 and some thousand. The rest is on a mortgage. This other one, I have 300 and some thousand tied up basically because it's paid off. So it surprised me that this one that had the mortgage on it that I make less monthly, I'm actually getting a better return. And to his point, moving it over, adding a little bit of money, I'm making a much better return.
And so for those of you who are completely afraid of debt like Danielle, this was a lesson for her because I was like, listen, I get you want to be all cash. I have no issue with that, by the way. If you're heading into retirement, great. Danielle's not retiring anytime soon. So I'm like, you've got this debt at 2.6.
Yep.
I mean, that means that she doesn't have to imagine you 2.6. Like that is so good. So do not sell that property. You have the most amazing debt on it, and you don't have much equity in it. And so if you translate the equity she put down plus the equity she has and the net, it makes so much more sense. In that particular case, she's making way more money on the on the property that's levered than the one that isn't.
Right. That loan gave me such a good asset, even though this condo I'm selling is actually much nicer. Right. I actually prefer it than the one I'm keeping, but just because of that mortgage, you know.
So you have to look at the whole capital stack, all of it. The money you put down, the debt, the equity you have, plus the debt and what the cost of that debt is. And in the case where it was completely paid off, she was actually making less on her equity.
Exactly, which is interesting. So, but let's talk about, what people are saying about the recession. So JP Morgan economist came out and said he's projecting a 40% chance due to trade policies and government measures.
Well,
so
he died a long time ago, by the way. So I'm just totally messing with you. Hey, by the way, when you said JP Morgan.
Oh, sorry, totally JP Morgan. Okay, so, you have to explain. I don't think people understand that.
Sorry, I was just such a smart ass sometimes. Okay. But I will tell you this. I had to laugh when that came out because I was like, everybody's like, oh my God, 35% potential recession. I go, well, okay. that's still like 35%. Like it's still low. Like most people go 50-50 and then they freak out when they're over 50. Like it's still way below a 50% chance. And I know it went from 20 to 35, but it's still super low. I had to laugh at that. Whoever wrote that up probably got a call from Trump. So why did you publish this? But they are a credible source, and I'm sure they have really good data behind it. But it's still super low. I'm not at all worried about it.
Exactly. But even if there was a recession, it doesn't necessarily, it's not a great recession. You know what I mean? Like there's different types of recessions too. There's shallow recessions. I will say with Trump keep going back and forth on these tariffs, he needs to make up his mind because it is affecting the markets. But,
I know. It's driving everyone nuts. Doesn't drive me nuts.
So what should people be looking for when they're looking at the job numbers? The U6?
I think so. I think the U6 is super important.
Okay.
It's one of those things where I dug into this years ago because I was like, it just doesn't feel like these unemployment is this when and so sure enough, there's other markers behind it. U6 is the one to watch. That went from 7.5 to 8.5 just in just a couple of months. That to me is one that you should be watching, not just the 4.1. That also went from 3.7 to 4.1, but it's discouraged workers and part-term workers are a big piece of this economy.
Yeah, absolutely. So let's get into some questions. Those on YouTube, please feel free to ask. I'm also going to pull one from our premium subscribers. So C. Smith asked, I hear a lot of green card holders are not being renewed even after 25 years. Do you think vacancies will increase if this group of people have to leave? It's
really possible, for sure. It depends on how big it is, of course. Yes. I mean, all of this stuff is really interesting to me. Anybody who leaves for any reason potentially impacts the economy, right? So it could be construction workers. It could be tenants. Could even be homeowners. I have a friend who had their green card from Canada, and they were freaking out. And they finally got their immigration not long ago, like a couple of years before Trump got into office. And they, one works in the as a financial planner, and the other one works, also in the financial services business. And two really good jobs, both Canadian, and they were freaking out. So yes, those are big things. They're not always who you think they are, and so I think that could, it just depends on how big.
Yeah, how big, and then also, how many people do leave or whatever, just because their green card expires. I don't, Trump made a really big deal that he's going to just deport everybody. I mean, we're just not seeing that right now. I do think that he's going to go after certain like criminals and things like that, but it would be very interesting if he really was deporting hundreds of thousands of millions of people.
Well, I think one thing to watch is some of these sanctuary cities where they were master leasing things like hotels and apartments and all these different things to house some of that, and you're going to see now that move the other direction. So right. For sure, but that's going to be pocketed. This is one of the things that we're definitely going to be addressing at Limitless. You guys, some of you have been to that conference. We do that once a year, Tarl and I, at the end of July this year. It's also at the same spot at the Gaylord Texan. But, we're going to have 50 speakers all trying to figure this out. Like it's super confusing. Where are rates going to be, for example? What's going on with the home builders? What's going on in the multifamily market, as you guys know, all that stuff. And with the migration stuff, especially in Texas, as you guys know, the border in Texas, the border in Arizona is a big deal. We're right in ground zero for most of that stuff. So we'll be addressing almost all of that.
So I didn't write down their name, but she had a really good question. If Trump eliminates FHA loans, because he keeps talking about eliminating FHA, making Fannie and Freddie private,
yep.
How might a freer market approach to housing affect someone who wants to start investing in real estate?
Well, right now, Fannie and Freddie are really, really good things for me.
Right.
You know, I mean, we just did a 35-year amortization, 10 years IO or interest only, and we did a buy down on the rate for 5.1. That is really, 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 really good debt fixed. So that's a deal that we're buying right now that will close on May 7th. It's a beautiful 300-unit property in North Scottsdale. So there will be disruption, right? So I don't exactly know what, but some of these government programs are really good. Like we're doing another development with, it's called a HUD, H-U-D, HUD. Most people know what housing and urban development is. But there's a program called a 221D4, which is a one you use for new construction. It's a 40-year amortization. It's been around forever. So these tools that the government are using are good tools. They're well thought through. They're onerous. They're tough. I'm not saying that they're not. But, some of these are tried and true. And so the disruption in some of these categories, in my opinion, could be negative, but I don't know. It stands to, we don't know yet. What do you think?
Yeah, I mean, we'll see. I think that, anything sponsored by the government is it's helpful in these situations, because they take some of the risk out of it, making it.
Let's just be clear. Most presidents want a balanced housing. They don't want housing to go really crazy in price. If you go way back, we talked about this before, the Clinton and the Bush era, and even Obama it was all about American dream, down payment, all that kind of stuff. So anything that has to do with first-time home buyer or affordability, I would expect something like that happening, and that's got to come from a federal level. I just don't see those programs coming from a private company. And so they're going to have to push it from a policy perspective at the presidential level. And so I do see that coming because affordability is a problem.
Yeah, absolutely. Jack is asking, houses are down in gold ounces from the 1970s by 80%. Houses are up from the 1970s in IOUs. So basically after we got off the gold standard.
Yep.
Do we have an IOU gold problem?
Debt problem, yeah. So it's a great question. It used to be said that you could buy one suit for 1 ounce of gold, like in London. If you go back and take a look, it's a very interesting thing. So I guess it depends if it's measured toward inflation or not. So there's, and I'm sure he's a gold guy, so I'm sure he's got some really good data around this. For those of you who might not know, the gold standard was that the dollar used to be backed by gold, and I think it was 71 where Nixon pulled it off the gold standard, which was the Bretton Woods Agreement, and then the dollar became floating and became fiat, what they call fiat, which means you could print it into existence, and that's what really created a lot of inflation that we're seeing today. There's other things too. There's wars and those kinds of things, but And then, of course, we started seeing debt. But the other thing that I would just, want you to look at is we went from one working family, let's say, I don't want to be, be careful here, where the father, let's say, was in the home or the mother was in the home and the father was working, and then it went to 2, and then it went from 40 hours to 50 hours to 60 hours, and then now you got 2 working spouses working a lot of time. And so all of this stuff has happened during that period of time. So I think the lifestyle has also changed a lot from that period of time. So yes, I think the answer is it Jack?
Yeah.
Jack was saying, yes, people are way more in debt, credit card debt, house debt, every kind of debt you can imagine.
But the government is printing, so you may as well get into it because these IOUs are our new currency.
Yeah,
gold
and I
is
think
no longer.
if you really want to take a look at, that's the narrative around Doge, right? Is they're going to try to cut $1 trillion out, and that's great. But I think you also got to take a look at the Medicare, Medicaid, Social Security. All those kinds of things are massive, massive expenses. that have already been paid into, by the way. Like, so don't forget about that. So the government has the ability to fund those, and they will, and that could be inflationary. It's definitely not going to be transitory, as we've heard.
Matt has a good question. He said, what's your thoughts on the Midwest right now for real estate? I'm seeing more and more investors moving in from the coast to buy here.
Yeah, I think I definitely know you're right. I personally have invested with a couple great guys, 3 of them out of Cincinnati. I'm literally an LP in a deal with them, and it's been wildly successful. Now, that's one market, one city in Ohio. Daniil's from Ohio, and they know the market. They live in the market, and they're in my mastermind, the collective inner circle, which I do 4 times a year. That's how we met, and that's how I invested. I trust those guys. And however, I also know from being there, and we bought some billboards in Columbus, and there's a lot of people looking in the Midwest right now because of price. So the question is how many renters are there?
Well, right.
Are renters and employers moving there?
Well,
that's the issue.
And somebody, I think we ran into somebody that's really losing on a couple deals right now from syndicators that are in the Midwest.
Yeah.
And something that came up when we were chatting with him was the weather and how much work these homes need. And to be fair, coming from the Midwest, I mean, we have winter roof issues, ice, cold, snow. We have summer, we have rain, we have winds, we have tornadoes, we have storms. It's a lot of weather things in the Midwest that if you're not familiar with the Midwest,
that's quite a list, by the way.
There is. It's a lot of things, right? So you do have to be knowledgeable. I would only invest with somebody in the Midwest if they live there. Period.
Yeah.
Either live there or they had people on the ground that were really thorough that lived there.
Really good point. Because I asked him this question. I said, I'm investing in the Midwest. I'm having a very good experience. Mm-hmm. He said, I'm investing in the Midwest and I'm not. And I said, what is the difference? He said, the people I invested with aren't from the Midwest.
Right.
They don't understand the Midwest. They picked the Midwest. So I'm not saying, this is a big region, right, guys? So we're putting a broad brush over the middle of the country as if it's like a submarket of a town, but it's not. There's a lot that goes on in these towns, as you all know, in the submarkets specifically. So if you're going to do that, make sure you really understand the market, because I know for a fact, here I am in Phoenix, as most of you guys know. Downtown Phoenix, as I mentioned to you guys before, is 4 months free on a 12-month lease. Just go look. Just Google downtown apartments and just start looking. You'll see 3 and 4 months free. We looked at one 2 weeks ago, 4 months free. And guess who those folks are? They're all out of state. We all the locals are not downtown Phoenix. They're not building these mid-rise. They're all out of state. So when you make a decision to move to a market, you better make the right decision. And there's massive advantages to people that are local, no boots on the ground. There's one side of the street, as you guys all know, can be very, very, very good, and the other side cannot be. It can be just a freeway, it can be a highway, it can be all kinds of things. So just those are little things that add up. So when you say Midwest, just make sure you're with somebody who really understands.
Absolutely. And then let's pull up our premium question from George. George is asking, what are some safe, low-risk ways to build passive income? I have a lot in savings, and most of it is in a high-yield savings account. Would a REIT be worth it to dip my toe in?
I would put, the first one I would say keep it right where it is for now. I would not be actively investing unless you specifically can beat that high interest savings account personally. And the REIT depends on what they do. So, for those of you guys, a REIT is a real estate investment trust. It could be an office REIT. It could be a medical REIT. It could be a core apartment REIT, which means they're investing in downtown, like I just mentioned. Probably not a good REIT. It could be a value add REIT, which is not a lot. So you got to take a look at the actual REIT. And then, of course, there's a tremendous amount of fees inside of those REITs. If I were you, I would hit pause for just a little while. Let's see where all this goes. Let's see where the tariffs head. Let's see where these unemployment numbers go. And if you're heavy in cash, just keep it in that 4 to 5% range. Because the one thing that you won't get potentially is a lot of tax savings. But and that's one reason. I actually had somebody text me this morning, said, what about this? And I said, well, why would you do that? And they said, well, I'm selling some things this year and I'm looking for tax. So those, keep your eye on the bonus depreciation, and the opportunity zones and stuff that hopefully is supposed to come out around May, around Memorial Day. We're all hoping that Trump, re-engages the opportunity zones, which he started, and then the bonus depreciation, because then you can get 100% write-off. So that would be another strategy. So just looking at the other side of the picture. But for now, I would hold.
Absolutely. And if you guys want to join our premium, just go to kenmcelroy.com /join-now, and you can ask Ken questions. You get access to our YouTube videos ad-free, podcast ad-free, etc.
Yeah, and don't forget Limitless. By the way, we got a code KEN10. You guys don't forget about that. That is going to be fun. I've been meeting with Tarl. He was here last week. We went to the NCAAs, the wrestling tournament in Philly, which was unbelievable. And you'll see us there for sure. Our whole company will be there, and we'll have about 2,000 people again and about 50 speakers. So make sure you don't miss that.
Awesome. See you guys next week.